Course, I'm back with another new flow. It's 2023, and yet it seems very few know you really must keep your leverage low. Now, be careful what you borrow, or it will all end in sorrow. It's risky playing catch up. Now, who have we got for mystery matchup? In this first show, we're talking about debt. We won't be preaching about our number one bet. It's mystery matchups, a new conversation, increasing the entropy just like condensation. We're discussing sovereign but not individual. You already know how to save your residual. Enjoy the show. It should be fun. Pleb Underground Special, Episode 1.
That's right, everybody. Thank you very much for joining us. It is the Pleb Underground Mystery Matchups, the first episode of its type. We've got two guests. They don't know who each other is, and we've brought these two guests together to have some awesome conversation. Walton, do you want to add to that before we bring on our first guest?
Yeah, so this Pleb Underground is a collective of a whole bunch of Bitcoiners producing Bitcoin media, whether that's memes, writing articles, producing YouTube shows, podcasts, etc. The Pleb Underground YouTube show is a weekly show that Phil and I do. That you can find on this channel. But that shows more kind of news and analysis. Phil's been then dropping some shorter clips looking at items and news bits like midweek, and I thought we'd like to have a longer, more in-depth discussion about a few different things, and make it more accessible to plebs. Like there are a lot of shows that are pitched at certain levels. I think this is hopefully quite accessible to most people. It's not going to be it's going to be hopefully translated in terms that normal people can understand. So I hope we do that for you. Please, if you're watching live, please send us some comments, and it'd be good to know. But the purpose of mystery matchups was especially that you often get very similar conversations happening on a whole bunch of podcasts when the same guests or the same groups of guests kind of go around the circle, so to speak. And I wanted to create different kind of conversation here, and so by doing mystery matchups, we're going to have different mixtures of guests than you might have experienced on other Bitcoin shows. Hopefully it works. Enjoy, guys.
That was a much more in-depth explanation than I gave. I appreciate that. Definitely appreciate that. Okay, so without further ado, we're going to bring our first... what's up, Walton?
Yeah, so episode 1, we're talking about debt. Like, and this is going to be not just like personal debt, sovereign debt, debt spiral, and hopefully we've got some contrasting opinions. But hopefully, you all learn some more. Please like and subscribe. Phil, our first guest.
Absolutely. And we want to learn some more too, right? Like never
absolutely.
Right? Like this is part of it. So because these guests definitely in both cases have talked over my head a few times, and I've had to go back and Google some of the stuff that they said so I can understand it. Anyways, let's start off. Let's bring our first guest. Here we go. None other than James Lavish. That's right, James. Great to see you on Pleb Underground on the mystery matchups. Really appreciate you joining us.
Yeah, I'm happy to be here. Thanks for having me. Sounds like a fun program.
Awesome, man. Awesome. And we're going to bring you onto the regular weekly show as well. But at a later time when things have calmed down. But look, for the people who, not that I think that anybody doesn't know who you are, but if they don't know who you are, just give a little bit about yourself and everything.
So I am a longtime institutional investor. I've been in hedge funds or private equity for almost 30 years. I'm a lot older than I'm about you two put together, I imagine. So,
Yeah.
No, I doubt
so
that. I
yeah,
doubt that.
I call myself a reformed hedge fund
180.
manager because back in 2020, I bit the orange pill, and I understood, and I really understand Bitcoin as a solution to so many of the problems that we have in this world right now. So yeah, I've met a lot of people in this space, some of the most intelligent people that in all of investing right here in the Bitcoin world. So I'm happy to be here and talking to you guys.
And thank you so much. That is absolutely awesome. And I really appreciate, I really do appreciate your takes. I think that, especially coming from the background that you come from, I remember the first time I met you and that you explained that you come from traditional finance. I was kind of shocked because of the types of tweets and the takes that you take, I think are much more
You mean
orange
because
pilled than I
James
would.
actually thinks? Because James actually thinks, rather than kind of just repeating verbiage that someone else is saying, like most people in traditional finance.
I try to think. It's hard, man. You get brainwashed. It's really difficult to get out of that money mindset.
Institutional bias. It's funny how they talk about that on the CFA, and yet like everyone seems to have it, despite.
Right on.
Absolutely.
100%.
So
yeah, and so what I do is I try to do in this world is I try to take my experience and my knowledge and bring it to a level that everybody can understand. It's not that difficult. The concepts aren't difficult. It's just the terms and the terminology and the acronyms, and it's confusing for people because they haven't been taught it. It's criminal that we're not taught this stuff in school. And that's what I'm trying to help people overcome and get that knowledge in a way that's really simple for them to understand. So I have a newsletter called The Informationist that I put out every week that just takes one financial concept and breaks it down super simply for you. So it's that's kind of what I do, and so you see that in my posts.
Very nice, very nice. Yeah, we've got people in the chat calling for Walton to take off his shirt, but
not today, guys. It's still January. Like maybe when it's the summer again. Like, come on, slow down.
All right.
So anyway, guys. So today we want to talk about debt. I think firstly, I think we talk a lot about money versus debt in the Bitcoin space, right? Because Bitcoin is very much money, and fiat is debt essentially, right? And to me, the difference between them is that debt is essentially like a contractual obligation to repay something in the future. There's a kind of there's a difference in time between when the two parties kind of receive their end of the deal. Whereas with money, if money is transferred, that happens kind of there and then. But the more important kind of difference is perhaps that debt is something that should be used between parties that know each other, whereas money is something that should enable trade between parties that don't. In the fiat system, the fiat system is a debt-based system. James, perhaps you can kind of give us a bit of a background on kind of how this debt-based system, I don't know, came to be or has evolved to be kind of what it is, and where you think we're headed in the future.
Yeah, I mean, look, just to keep it simple and quick, debt it's a way to borrow against future productivity, right? So you're basically borrowing something to produce something that you're promising to produce in the future. That's what you're doing. So if you don't produce enough, then you can't pay back what you borrowed. So you have to be able to produce enough plus a return for yourself for it to make sense, right? And so the problem is, we as countries, as developed countries, when we came off the gold standard and we started borrowing more and more we were able to borrow more than we were producing because we didn't have to tie our currency to something that is tangible that we have to have in a vault, so we could tie it to something that's just a promise. So debt became something that enabled us to grow our economies pretty rapidly. And so you saw us expand pretty rapidly over the last number of decades. However, what we also saw is that debt can create bubbles because you can borrow if you find a lender that is willing to lend to you, even if you're a very risky borrower, then it can create bubbles, especially if there's a lot. And we saw that in 2008, the great financial crisis. And that's the problem that we've created in this world.
That's the scene in The Big Short where they go and find all these strippers that seemingly have five houses and that sort of thing.
Because they were able to borrow. They were able to borrow all this money and rent them out, Airbnb, and next thing you know, and they can't make their rent payments. Why? Well, because they didn't really understand the risk, and the risk was that they were borrowing at variable financing rates, at variable interest rates, and as the interest rates went up, they suddenly couldn't make the monthly payments, and so they had to short sell their houses or just default on them. So, and that's the problem, is that America has gotten absolutely addicted. Well, not just America. You can see it in Japan. You can see it in all the developed countries, America, and we're in Europe. We've gotten addicted to debt, where now we're borrowing more than we make every year. And so the problem is, and you guys have heard me talk about it, is we've entered what we call a debt spiral. And I can go into that more later, but basically debt in and of itself is not a bad thing, because you can borrow against future productivity with it. That's not the bad thing. It's when you don't understand the risk of it and you over leverage yourself and you put yourself, what we call in our business, we call it, you get over your ski tips, where you're so far ahead of where you should be, you wind up tumbling. And that's what we're watching kind of in real time. We saw it in the great financial crisis, and now we're feeling this pressure of all these developed countries getting over their ski tips. So
yeah, so there was a comment there. They said fiat money is debt. I would say fiat currency is debt, right? Is that you'll see it's I promise to pay the bearer of this blah blah blah, whole load of nonsense. But it doesn't actually represent some piece of fraction of gold anymore. Like there is nothing truly backs fiat currencies, right?
Nothing truly backs a treasury, right? And well, look, anything can be currency, right? Everybody uses dollars because they trust that it's stable and it stores your value. But people are waking up to the fact that your value, your hard-earned money that you've attained through work, is being eaten away every year by inflation. And so people are starting to realize that, and this is not that great of a store of value. So do I go back to gold? Do I go to Bitcoin? Where do I go? And that's one of the issues that we face right now. Bitcoin is by far, it's not even close. There's nothing that even comes close to it as far as the ultimate store of value as it's structured. But it's got to have a larger market cap and less volatility for people to trust that. So the thing is, the US dollar, it gets eaten away every year, but you can trust that if you put your dollars in the bank, that you'll have a few percent less next year, but you're not going to have 70 or 80% less. At least that's been the issue with the stores of value. And that's why gold has been arguably a strong store of value, because it does have more volatility, way more volatility than the US dollar, but you can see it moves up with the money supply. So that's just what it is.
We actually have a question from one of our viewers here. DJ Satoshi is asking, is that, before when you were talking about the growth, he's asking, is that growth legitimate or simply growth on paper? And before your answer,
like borrowed growth, right? You're essentially, it's a bit like stare again. You can compare these things to biology, right? I think using QE is a bit like using steroids. You're pumping your growth but it's not sustainable, and it can cause systemic problems at a later date.
Exactly. I mean, look, we've had so many advances in I hesitate to say medicine and pharmaceuticals because that's been a nightmare recently, right? But we have had some, and we've had tremendous. I mean, look at the technology we're using. We're all sitting in different areas. I mean, like this is incredible. We borrowed against future productivity to create all this. People trust that they're going to get paid back later, by somebody creating all this stuff.
Okay, so our next guest is here, but I wanted to say the question
also to our listeners that are desperate for the other guests to join. Yeah, they're just about to join. Please be patient.
Yeah, exactly. The next guest is about to join. But what I was gonna say was, you know what you were just talking about before, right? We borrowed against our future productivity. And what I'm thinking is, did we actually have to in order to have these breakthroughs? See, this is the thing.
It's more that once one country, if one country is, then another country is going to as well, because it became about geopolitical positioning, all this sort of thing.
Yeah.
I don't know. I think it's like a bigger topic than that, because we really won't know. Sorry, James.
Yeah, no, the answer is you don't have to, but it does accelerate it. I mean, look, you just think about it. If you want to go, just yourself, if you want to go and open a restaurant, you can do something where you work for enough money that you get in the bank that you can go open that restaurant in a few years. And then you can, because you have to make enough money to either lease the real estate, to pay your workers, to buy them the products, to buy the meals, to buy the tables, all the plates and the cutlery, or you can borrow a bunch of money, open the restaurant, get it going, and then pay that debt back as you make money in the restaurant, because the restaurant can open in weeks rather than years. Does that make sense? So, I mean, it's just like, that's how it can be good. Now, if you said, I'm going to open a restaurant, in the worst, on the absolute worst corner of the street, that real estate has never worked ever, and I'm going to open a restaurant that's new and exciting, and it's going to cost a ton of money. Well, that's a lot of risk. It's probably a dumb thing to do, So yeah.
What you're saying is it comes down to being responsible or irresponsible. And I think that's a perfect moment for us to introduce our new guest who likes to toe this line quite frequently. And of course, that is Magoo.
Magoo.
Mystery matchup number 2.
Mr. Matchup.
I would have expected to have a Zoolander photo out.
I would. I try to Photoshop the duck lips. Didn't have enough time. I was late as it is, so I thought I'd just throw up the classic avatar.
It's very well known. Thank you so much. Thank you so much for joining us, Mr. Magoo. Really appreciate it. Okay, so I don't know if you've been able to hear any of the conversation that we've been talking about right now, but essentially,
just back to the concept of mystery matchups. The idea is that we're going to have different combinations. I feel like James goes on a lot of prestigious shows, ones that wouldn't entertain Magoo, and so this conversation doesn't happen. But here it is, live from the Pleb Underground. As Green Candle is saying in the chat, let's fucking go.
Yeah, I'm James is in the castle per se. I'm outside on the streets hanging out with the clientele of Jack the Ripper.
I am working, dude. You don't need to even work. So.
Magoo's in the bathroom by the sounds of it.
That is so backwards, man.
I'm not in the bathroom. I'm just in a big room.
He's got this little photo of Magoo. Half the listeners don't even know what that is, and he's not to be taken seriously. The guy is smart, man. He's really smart.
Wait, he's smart, but he's not to be taken seriously.
He doesn't want to be
because he made Greg Foss cry. Is that what this is about?
I thought
that was not me. That was not me. Yeah, just to bring it back to what I was listening to, what some of James was saying, and just like the overall discussion about debt being good or being bad. I think James is right. If you had a somewhat of a laissez-faire aspect when it came to debt and in the rates of debt that is being issued. The problem is, so James is talking about, it's good if you know what you're doing and you're making wise decisions. And everyone is basically making their decisions based off of incentivized economics, what they think is good, and vice versa. The problem comes in where you have central planners and the hubris thinking that they can move where they dictate what the yield or what the rate of the cost of capital should be. And even if people are smart and making the best decisions that they can be making, they're making decisions off of data points that just aren't reality in the free market because they're being manipulated by a central planner, and they're destined to make bad decisions when you have such a dichotomy happening in the economy. And so even if you're smart and you're making all the right decisions that James says is good when it comes to issuing or taking on debt to kind of project out your growth, essentially, you could be making decisions on just absolutely bad data that you think is good, but it's bad. And so the way that I look at it as well, like it comes down to, there's two kind of separate debt issuances, right? Like you'll have sovereign debt that's being issued, and then you'll have like corporate or commercial debt, like more real debt that's being issued, that's being put into the economy. Obviously, if the treasury spending, it goes into the economy. But at the end of the day, we haven't had a recession in like 14 years, 12 to 14 years. And so when you make bad decisions, you need to cull the herd, right? Like you need these people making bad decisions to actually not be around anymore. Because if you keep them alive, they're just going to do more. You're giving capital to people that are not using it wisely, and you're not punishing them. You're rewarding them.
So let's talk about it. So back in 2008, 2009, there are some big banks that should have absolutely fucking failed. You know, they should have failed, but they didn't. And so, like Magoo is saying, I agree with you, Magoo, that, you know, they did not suffer the consequences of their idiocy. And unfortunately, you know, we all subsidized it. You know, I mean, we subsidize it through our tax dollars and issuance of treasuries and QE. And, you know, for your listeners, what does that mean? It's the money printer go burr, you know? And so, yeah, it's absolutely true that, and maybe that's the point, is that there's no way for you to have responsible debt issuance in this world now because of, like we're talking about. Just to break it down for your listeners. You know, what Magoo was saying was that central planners are deciding what rates of return you're going to get on your debt, and they set the rate, the federal funds rate. It's the shortest rate. You know, it's the overnight rate basically, and everything else is keyed off of that. And right now, what the market is saying, because look, if you borrow money for a week, you know, from me, I'm going to charge you one interest rate. But if you borrow money for a year or 3 years or 5 years or 10 years or 30 years, that rate is going to go up. Why? Because I'm committing my money for that much longer to you. So I need a higher rate of return in order to be compensated for that longer period of risk, right? Well,
and as Tom Cruise would currently say, it's because I'm inverted.
Exactly, because I'm inverted. And that's it. So now what we're seeing is that the entire market is saying we're going into a recession, and the Fed's driving us there. And so the rates are going to be lower in the future. So you can you know, borrow if you could borrow at the 30 rate and then, you know, and lend it out at you can invert it. You know, and that's what you're saying, is that, look, the right now, the market is telling us without doubt we are going into a recession, and that you know, anybody who's borrowing at short term is going to get hurt from it. So.
You know what's interesting about that that you just said that? I actually was just looking at Visa's quarterly report, and they just explained that their numbers right now in terms of transaction volumes are 41% higher than they were in 2019. Wow. So I'm not saying what you're saying is incorrect, but I'm saying
that's probably just because people started using Amazon.
Going on.
So,
I-
so
I-
let me
Yeah.
take a different view on that. So in 2019, what I take away from that is people weren't using their credit cards as much, meaning they didn't need to use credit. Now we're in this point, like most people that are even on Bitcoin Twitter, they haven't even been alive for one market cycle, so they don't. They're just not aware of what a market cycle actually looks like. And when you get near the end of a market cycle or a business cycle, you see the shift from people, the reduction of their savings, and then you see the increase of use of credit instruments by retail people to sustain their life the way that they need to sustain it. And so the credit goes up, right? And then you get to a certain point, and then credit delinquency starting a domino effect itself. And so what I see from there is more people are becoming reliant on credit to sustain themselves in their lifestyle right now in 2023 as opposed to 2019.
Yeah, and a little bit more context on that. I wrote this down in my notes the other day. Is Citibank said that debit card spending was only up 1% last quarter, and credit card spending was up 17%. Okay, so people are swapping. Why? Because they don't have money in their bank account, so they're swapping for credit, and the balances, their year-over-year balances, are up 22%. And yeah, it's gonna be painful for a certain demographic. You see all these numbers that come out about, oh well, the personal debt's not that high and personal savings is still pretty good, but you don't see the demographic, right? I mean, there was a statistic out that just came out a couple days ago and was like over 60% of people who are making over $100,000 a year are living paycheck to paycheck. That's just nuts, right? They're not saving money, right?
Oh, even people that work in San Fran, like it's insane. Like it's not just people that are working your minimum wage jobs. Like there's wage slaves that are working at Fortune 500 companies making $200,000 a year, that their lifestyle is so extravagant that they're still just making it by paycheck. Like it's not like a saver's economy.
I don't know if you've seen, certainly in the UK, I've seen a recent kind of increase in the supply of housing of real estate at a kind of higher level. And I think it's these kind of people, these professionals who are making, six figures a year, that have bought and kind of overextended themselves, now having to kind of downsize, as their companies do the same.
Yeah, and so those are usually, if you want to kind of touch on real estate, like, so those are, everyone now has been, at least for the last 20 years almost, or post GFC, people have been looking at real estate as kind of like a store of value for the most part, right? And they're putting all of their capital into these quote unquote
for 80% of the population. It is the primary store, their primary store value.
It is, because realistically, if you want to look at like equities, so in America, 89% of all equities are owned by 10% of the population. So that lets you know that basically almost nobody in America actually owns equities or owns probably debt instruments like T-bills and treasuries and bonds. They're just, most of their wealth is in the real estate market, right? And this is if you want to talk about the wealth effect, and why the Fed, I think, why the Fed needs the real estate market to come down is because that's the only way that they can actually subside consumer spending, is because they need to make them feel poor, right? And most people get their sense of the wealth effect from their real estate and how much value it has, or how much refinancing or line of credits or HELOCs they can get off of the value of their housing. And so that's why I think the Fed, James says that they're pushing this into a recession. I think that's by design. I think they're doing that on purpose. I don't think they're just making a policy mistake. I don't think it was a policy mistake in their eyes to be so slow on inflation going and raising the rates. And I don't think it's a policy mistake in their eyes of over tightening. I think that that's their design plan to do that.
Yeah, it's a good point, but I think it's a little bit more nuanced than people are giving it credit to. I think that they all think, a lot of people think the Fed and the Treasury, these people are just morons. They're not morons, They're dancing a very, very tight line here. So what do they need to do? They need to get inflation down. Why? Because if you have runaway inflation, then it puts pressure on the U.S. Treasury as a store of value. Okay, so you cannot have that. Not when we are running deficits that are over $1 trillion a year now, and we have $31 trillion of debt that we're just adding to every single year, right? So we've got to make sure that treasury market remains liquid, that it remains the global store of value. It must be, right? So they need, number one, to get inflation down. They don't want to drive us into a depression. They don't want to just teach Americans a lesson about borrowing. That doesn't do any good. Why? Because then it kills GDP, which forces us to spend more, right? So they can't do that. But they do want to get inflation down, or at least the perception of it. However, they don't want to drive it into the ground. They don't want deflation. They can't have deflation. Absolutely 100%. The Treasury cannot have deflation, but the Treasury needs inflation. Why? Because we've got so much debt on our books, right, in the United States, $31 trillion, that we have to inflate it away nominally. Well, how do you do that? You do it through what's called negative real rate of return. And what that means is, for your listeners, what that means is that the inflation rate is higher than you can actually get in the marketplace for debt, right? So the Treasury rates are they're not compensating you fully for the inflation rates, which means that, what's that?
And no, and I was going to say that's why they were so slow to actually start raising the Fed's funds rate, right? Because they needed that dichotomy of the inflation rate being higher than what they're actually paying on the debt that they're issuing.
Right. So what I put out a piece this weekend, and it was about and you know the punchline is that, look, the Fed is using this adjusted CPI number, and we don't need to go into that, but they're adjusting it again because they need to manipulate it to show that inflation's lower. Why? Because they don't care what Americans feel. They don't care what we actually are paying in the grocery store. They care what other countries and other investors and other sovereign investors think that we're paying.
There's no bigger lie than CPI.
Exactly. So they need to make the CPI look a little bit better than it really is, but then let it run at somewhere between 3 and 5% for as long as they possibly can. The perception of it. Now, we all know that we're paying far higher than 6-7% inflation on most goods, right? I mean, come on, we'll go into any store, any
and that's why all these people, James, that you spoke of earlier, are no longer saving, and why all their credit card bills are racking up is because their everyday, every week costs, their food, their fuel are going up. Because finally, you can no longer export all of this in inflation by increasing globalization and and asset prices booming. Now finally the commodity prices are going up and hitting these people that live week to week or month to month who try to save a little bit.
Right.
So that's also why I believe, so like what James is saying, you need to juice the pig. So you need inflation higher than what you're paying. And you can't, at least I don't think they can, because the psychology and the perception is everything. What James is talking about, showing other sovereigns, other people looking to bring capital into the United States and using U.S. treasuries as the global reserve asset, and it needs to remain liquid. I believe if they just held it basically at let's say the yields were, let's say 2%, and let's say they said CPI was 3%, but realistically it was like 4 or 5%. If they tried to do that over a long extended period of time, people would wise up and they would not be willing to buy treasuries because they know the real yield would be negative. That's why I think that a lot of the times they're moving it up and down. So it seems sometimes they're juicing it a lot higher than they are. Then they start raising rates to make it assume or look like that they're actually doing something to combat it. And then sometimes it actually might look like, oh, now this is real yield. I'm getting real positive yield. Oh, but not for long. And then all of a sudden something else happens, and then they have to reduce rates again. Now it's negative in real terms again. And it's just like yo-yoing effect of being negative real yields to a little bit positive, but like over an aggregate period of time, it's going to be on average, you're going to be losing real yield. And
no doubt, but I don't think, and I agree with that's a good point. I hadn't thought about it that way, that they actually yo-yo it purposefully to obfuscate it. However, I don't think most people would realize that if inflation is going up 4 or 5% and we're saying it's 2 or 3%, it's going to take a long period of time for people to really wise up to it. It's going to take years and years, right? So, but
do you think the bond markets are that dumb? Like the people that have a bond mandate policy, whether it's annuities, pension funds, sovereign wealth funds, do you think?
No, they're not. No, yeah, but Magoo, they're not dumb. They have a mandate. That's all they can do. They have to be invested there. As long as they aren't getting killed on the bond trade, as long as they are making money for their investors, that they're making money for the pensioners, then they're doing their job, right? But it has to be like a year like this year where they get slaughtered that they wake up. And so, but I do think, going back to, I do think that eventually the world wakes up to it. I think the world calls us out, and unfortunately we're going to be, fortunately for us, the United States, but we're going to be the last one to get called out on it. There's going to be other economies that get called out first. And whether it's Japan or Europe, man, they're both in a world of hurt, and they're going to get called out.
And you are right. The United States is going to be the last cookie that crumbles. As shitty as a situation the U.S. is in, the Federal Reserve and our debt, because everyone loves to single out the U.S. with how much debt we have, but just given how the economy and the world economies actually work and how the debt system actually works, the U.S. is going to be the last one to fall. Like, it is designed that way. And how long is that going to take? That's anyone's guess. You've had people since literally 1913 been saying this, or since 1971. Peter Schiff's have been saying it for the last 50 years, right? Is it going to be 10 years, 20 years, 50 years, 70 years, 80 years, 100 years, 150 years? No one really knows how long we can juice this pig to the end of the road. But
I know, but what's interesting, Magoo, is that I agree. I do. I don't know how long it takes, but when you look at the debt chart now, man, the Fed and the Treasury, they are walking a tightrope, because if you look at the amount of debt now and the debt to GDP, if this thing could spike, so it could go up parabolic, so quickly. I mean, I think we have 50% of our debt that comes due in the next 3 years, which means that if the Fed holds rates here, and that debt, the average debt that's on the Treasury's books is like 1.7%. And they're having to now issue that debt somewhere in the 3 to 4 range, somewhere in there. So they're doubling that expense. Every single piece of debt that comes off the books now, they have to issue another bond to pay for it, because we don't have the money, right? I mean, we've walked through the math countless times. The United States doesn't make money, so we have to borrow it to pay off that old debt. So the question is, Magoo, when does it go parabolic? I mean, it feels like we're in the middle of it. Right?
I have my theories. So I have my whole theories on Keynesian economics and where the final straw could possibly be. And I center it around demographics, because you can play the shell game for a long time if you have good demographics. And what I mean by that is when the world's population is actually decreasing. So whether you want to look at the UN projections, projecting that out to 2100, where they think we peak around 2100 at 11 billion people, or there's other demographers that think we're actually going to hit a lot sooner peak population on the planet around 2060, 2070. That's actually going to be a lot less than 11 billion. It's going to be around like 9 or 10 billion. That, to me, is the ultimate end game for Keynesian economics in the debt system, because demographics is everything. There's a reason why boomers hit peak spending in 2007. It's not a coincidence that's when the GFC happened. And it's not a coincidence that millennials hit peak spending in 2024. And that's where they've been juicing this can over the last 14 years.
Why do we always just skip Gen X? I mean, I'm sitting.
Well, it's because, not to hate on you, James, but you are the smallest generation in the MTV generation.
We're just whatever.
Forgot.
Move along. Move along, Gen X. Move along.
So ultimately, I think the shell game ends with Keynesian economics when you have less people, because you can shell game it incredibly with immigration. And the United States, Canada have done this beautifully. Europe has done it horribly. Japan, they do not like people that don't look like them. China doesn't like people that don't look like them. So their immigration game is horrible. Russia has actually been relatively very successful with increasing their fertility rates to actually keep juicing their population. We can get into how they've done that, but they've actually started to got to a fertility rate that's maintaining their population. But United States and Canada have done a really good job at trying to do immigration. But ultimately, at the end of the day, when the world population peaks and there's less people tomorrow on the planet than there was yesterday, then it really gets hard to continue the debt-based system, because at the end of the day, it's realistically a Ponzi. You need more people coming into the system that are currently in the system. More productivity, right? And so that's when I think the end game is, sometime after that happens.
That's interesting. So, yeah, and maybe that's the point, is that if you read Jeff Booth's book, The Price of Tomorrow, the point is we need to get to a deflationary period before that, and a deflationary system before that, or else there's going to be a monumental collapse, and that's the problem. But I don't know, Magoo. I mean, maybe the numbers, maybe people just become completely numb and immune to them. That
they have
US
to.
Debt to GDP is 6 to 1, and we've got hundreds of trillions of dollars of debt, and maybe that's what happens, just because there's no other real choice right now. In people's minds, there's nowhere else to go.
So ultimately, I think Japan is basically what we're looking for. It's a little bit different because Japan doesn't have the reserve currency of the world, and we're able to export that.
And they're exporters, right?
Yeah. Right. So, but ultimately, I think all central banks are going to be the holders 100% of their said sovereign's debt. So there's going to be a point where the Fed owns 100% of the U.S., like the U.S. government's debt at one point, right? And if you want to be like an accounting head, what you can do when you now own 100% of your sovereign debt, that's when you can mark things to zero, right? Like, it's at that point, it becomes a belief system, because when you blow out these numbers of debt to GDP, the value of the money that you're using really just comes down to belief. Because if you look back in history and look at hyperinflationary events, it's not a number that you just cross this threshold. Like, I know people love to say, oh, over a certain percentage of GDP to debt levels, you just never come back. But you don't get that hyperinflationary event until the belief system is lost that the value is there. What that can be and what that looks like, it's anyone's guess, because the government has so many tools on actually propagating propaganda into changing people's belief on there. But as of late, I've also been thinking, well, what if the end, like as Jeff Booth said, what if the end's not an inflationary event? What if it's a massive deflationary event, in terms of like the dollar's not going to be hyperinflated away? It's just everything else on the planet is going to be so deflationary that it's just going to be a massive depression like event, rather than some hyper like Weimar Germany event.
Man, that's depressing, but I wouldn't bet against it. It's very difficult. The problem is, and I think you hit on it earlier, is that these systems are so complex. Everything is so complex. It's very difficult for anybody to understand what can and will happen. And that's why, I do believe we are in a debt spiral that eventually we do collapse, but I have no clue when that happens. And I have no clue if it's an ugly collapse, or if it's an off ramp to be an on-ramp for something like Bitcoin, and that's my hope. My hope is that that's what happens. And the question is, Magoo, is can we get Bitcoin to a spot where it becomes that on-ramp before we have that massive deflationary event?
That's the question. And this is why I frame it this way, because ultimately, if the current system collapsed today, I personally believe you probably need to worry about how many bullets are in your clip and how many bottles of water you have, more so than how many Bitcoin are on your hardware wallet. And so, as a Bitcoin enthusiast and a hardcore maximalist, I still understand the plight of needing this transition to actually probably even play out longer than I'll be alive. Because if it doesn't, because realistically, if I want to be a politician and use the words soft landing, if we want a soft landing of a transitional system from the current debt-based system that we're in with, which is money, and then slowly moving towards somewhat of a Bitcoin standard, or at least somewhere close to that, and we're living in a deflationary world where the population is actually decreasing and not increasing, you need Bitcoin to be almost at the relative size of where the existing economy is at, or the existing treasury market. So if you look at today, the world's sovereign's treasury market is something between, like, I don't know, 300 and 400 trillion dollars. And so over the next 100 years, say, you would want to see Bitcoin's value rival that of the debt markets, essentially, so that it can onboard the world's population, not just in terms of the individual, but the institutions, having that liquidity, having that size. Because if Bitcoin is today, whatever it is, like 300 billion, $400 billion, like, that's literally a fart in the wind when it comes to like global liquidity. And it cannot withstand the collapse of the fiat system. There's just not enough on-ramps. There's not enough liquidity. It'd be absolute chaos. And so, as someone who's quote unquote bullish on humanity, I would want to see this transition take place over the next 100 to 200 years, rather than take place over the next 5 to 10 years.
100%. I 100% agree. And I don't know what that number is. Maybe it's 100 trillion or 200 trillion, but everything's inflating so rapidly. It's probably, in the
James, is to me the more relevant metric, rather than like the total outstanding debt, is the percentage of tax receipts that pay the interest on the debt, because I think that's about 15% right now for the United States, and that's the number that's really going to rapidly rise as they have to renew all of this sovereign debt. Do you think that's the number that wakes up the normies once you start seeing, oh wait, half of our taxes go to pay interest on money that the government's borrowing? Like, is that? Do you think there's a particular number that might hit people?
Well, it's already. I mean, if you look at the projections that the Congressional Budget Office puts out now, they're projecting to take in $4.6 trillion of tax revenues, and our debt, the cost of our debt is over $1 trillion. So that's an issue. It's like 1.4 trillion. So we're already past that. I mean, like.
Oh, I think we just lost James there for a second. The audio just went.
Yeah, we just lost James's audio.
Sorry, James. You'll let us know when you're back.
Sounded like he unplugged his microphone.
Yeah, it sounded like the mic got unplugged. It was kind of like a double clip and then gone. That's strange.
It's the sound of a jack going off, is what you're saying.
Yes, exactly.
Well, then I can't get these things out. Oh, there we go.
Now we can hear him.
All right. Sorry about that. So, anyways, yeah. So that we're already past that. We just, I think we're just brainwashed into thinking it's all going to be okay. There's no other system. I mean, most people who are alive today don't remember the United States not being in some sort of debt situation. I mean, it's incredible.
You would literally have to be born in the late 20s or the early 30s to be in that's like you were going through the Great Depression, obviously, where the debt levels, because after World War II, like, debt levels have just been going up, basically, right?
Yeah. I mean, they came down in the 80s, but then they exploded through in the 2000s.
So I know we've been talking about how much the U.S. is, for lack of a better words, fucked in terms of like the debt that they have, and we know how much new paper that they issue every single year or every day, whatever time frame you want to look at it. But one thing I think a lot of Bitcoiners miss, specifically because most of Bitcoiners just look at like this, there are a lot of Austrian economics looking at this is the number of how many Bitcoins are ever going to be in existence. This is the hard cap, et cetera, et cetera. And with the US dollar, there's obviously no limit. But what a lot of people miss is the demand for the US dollar. Like, so we talk about this system finally collapsing, and a lot of people don't talk about the things that the US government can actually do to kind of kick this can down the road. So you see a lot of Bitcoiners talking about this is imminent, this is the next 5 years, this is the next 10 years, but they don't realize how many weapons that not only the US government and the Treasury have, but also the Federal Reserve have as institutions. And that's not even talking about bringing CBDCs or bringing in incentivized like economic behaviors of money and being able to control that with CBDCs, but also who actually wants to buy US debt, right? And what could also happen in that situation is as all these other currencies are failing, because they're going to fail before the US dollar does, and their central banks are going to fail before the US dollar does, what are they going to do in the meantime? Because most of them are not going to be prepared to be on a Bitcoin standard, because if you're a country that's running a deficit, and almost every single country runs deficits, you by very nature cannot go on a Bitcoin standard because you are actually spending more money than you're making and taking in. So your people in your country would just straight up starve and die. And so they're going to be looking around the world, whether it's at the IMF, whether it's at the United States for the dollars, they're going to look for a handout. And if the United States governments can dollarize countries at a fast enough rate, for if you see like countries in South America, whether it's Argentina, Peru, Ecuador, Colombia, Venezuela, or in Central America, or wherever, all over the world, or Africa, where they actually start to dollarize, you create more net demand for US dollars and vis-a-vis more net demand for US treasuries. So at the end of the day, that's the race. How much they need to print, because they have hundreds of trillions of even unfunded liabilities just in Medicaid and Medicare. So they need net new buyers of US debt. And no one really talks about what they can actually do to kind of create net new buyers of debt. If you even want to focus in on crypto specific, look at stable coins. That's a pretty big net buyer of debt. Like if you look at these stable coins and they start to get to be trillions of dollars, which I think some of them will be, like Circle, USDC, I think it's only a matter of time until they're in the trillions of dollars of market cap. And that's a net new buyer of US treasuries, right? And that's not even on a sovereign level, where sovereign levels may, like how many countries around the world are already basically dollarized? You have El Salvador, you have Honduras, there's Costa Rica that uses US dollars, Panama uses US dollars. I think you're probably going to see a lot of Africa start using US dollars with these stable coins and remittances. And so that in and of itself is creating a lot of net new buyers of US treasuries. And so a lot of Bitcoiners don't talk about that. They just worry about the supply, and they don't talk about the demand. And so, like, I just think that's a really interesting conversation to have.
Yeah, no, it's a good point. You know,
if I can just briefly, a little bit of housekeeping, because I know we've got a limited amount of time. What I want to do is we're going to transition over to Spaces, just so we can take a couple of questions from people who've been watching or listening. So Phil will be tweeting it out from the Pleb Underground account. We'll all jump in and continue the conversation there. James, did you have something final you want to say before we transition across?
It's a great point that Magoo is making there, that, you know, look, there are a lot of countries that cannot issue debt in their own currency. So they have to use US dollar based currency. They have to use, US Treasury kind of to piggyback off the fact that their currency is not, is not something they can borrow with. So, and it creates a lot of demand, and it goes back to Brent Johnson's milkshake theory, the dollar milkshake theory. And so, and that's exactly that's the race we're in. The U.S. will win. I think the U.S. will win, but it's going to be painful for a lot of people around the world, unfortunately. And that's what we're trying to tell people, is like, look, if you're in another country, just get ready. And I don't know if it's 10 years, 20 years, like Magoo is saying, it could be 50, 100 years, but the pain is coming. So,
I mean, realistically, the Fed has failed already 4 times in the past. You know,
yeah.
that just gets washed over.
Yeah, we just keep kicking the can, keep kicking the can. So, yeah,
that's right.
But
all right,
anyway.
guys.
All right, guys. Well, I'll try to join you over at on Spaces for a few minutes. I have a business call at 2:15, so I'll have to jump in just a few minutes.
Awesome. Thank you, guys. By the way, thank you everybody for joining us. Really appreciate it. Magoo, any final thoughts before we sign off? Well, and go to space.
No, I think James left on a pretty somber note, so I'll let everyone stew on that depression for a little bit here and leave it on that.
Yeah, excellent, guys. Yeah, please like and subscribe.
No, we have hope. Let's end with the.
I know. We do have.
We have the hope of Bitcoin. That's why we're here.
And don't remember, fuckshitcoins.com.
See you, fellas.
All right, guys. We'll see you in Spaces. Thank you, everybody, for joining us. Take it easy.
See ya.